Right now, as you are watching this, something is happening in the background of the global financial system that almost nobody fully understands yet, but everyone is reacting to, because just minutes ago, a headline started circulating through trading desks, private terminals, and institutional chat rooms. A headline that didn't come from a hedge fund, didn't come from a rumor mill, but pointed directly at one of America's closest allies, Canada. And the claim is simple, but the implications are anything but. Canada is selling US Treasuries, not quietly, not gradually, at scale. And the moment that headline hit, markets didn't wait for confirmation. They moved. The Dow dropped, the S&P followed. Tech stocks already fragile started slipping faster. Bond yields surged. Liquidity began to thin, and across Wall Street you could feel something shift. Not just prices, but confidence. Now here's the part that makes this different from every other market scare you've seen. This isn't just about numbers moving on a screen. This is about the foundation of the global financial system, and what happens when one of the most stable players in that system suddenly steps back. Because to understand why this matters, you need to understand what US Treasuries actually are. They're not just government bonds, they are the backbone of global finance. They are what central banks hold when they want safety, what pension funds rely on to preserve wealth, what financial institutions use as collateral. For decades, through every crisis, every war, every recession, when uncertainty rises, money flows into treasuries. That has always been the rule. But today, for the first time in a long time, we are seeing the opposite. Money is flowing out, and not because of panic from small investors, but because of a signal, real or perceived, from a sovereign country. And when sovereign countries move, markets don't question it. They react to it. So let's slow this down for a second, because what's happening right now is more than just volatility. It's a chain reaction. When treasuries are sold, prices fall, and when prices fall, yields rise. That might sound technical, but the consequences are very real, because rising yields mean borrowing becomes more expensive. For the US government, that means servicing debt costs more. For corporations, it means loans become harder and pricier to access. For everyday people, it means mortgages go up, credit cards tighten, and financial pressure builds almost instantly. And that's exactly what traders are seeing unfold in real time. Mortgage rate expectations are ticking higher, corporate bond spreads are widening, risk appetite is shrinking, and all of it is happening within minutes of a single narrative entering the system. Now here's where things start to get more complicated and more dangerous, because the question everyone is asking right now isn't just is Canada selling, it's why. And the truth is, there are several possibilities. None of them are comforting. One explanation is liquidity. If Canada needs cash quickly, treasuries are one of the easiest assets to sell. They're deep, liquid, and widely traded. Central banks use them all the time for short-term adjustments, but here's the problem. The scale being discussed doesn't look like routine liquidity management. It looks deliberate. Another possibility is currency defense. If the Canadian dollar is under pressure, selling US assets and converting them back into domestic currency can stabilize it. It's a strategy that's been used before by multiple countries during times of stress, but again, timing matters. And doing it in a moment like this sends a signal far beyond currency markets. Then there's the third possibility, the one traders are most uncomfortable even saying out loud: geopolitics. Because while Canada and the United States have historically been aligned, the global landscape is shifting. Trade tensions, military disagreements, strategic repositioning. Financial decisions at this level are rarely just financial. And if even a fraction of this move is politically motivated, it changes how the entire market interprets what's happening. Because now it's not just a transaction, it's a message. And once markets start interpreting moves as messages, things can spiral quickly. Here's how that spiral works. If one country sells, others start asking if they should sell. If enough investors believe others will sell, they sell first. That pushes prices down further, raises yields even more, and reinforces the original fear. It becomes a feedback loop. Self-reinforcing, accelerating, difficult to stop. And that's exactly the kind of dynamic traders are trying to avoid right now. Because the real risk isn't Canada selling, it's who might follow. China holds over $1 trillion in US debt. Japan holds even more. European institutions are deeply exposed. If even a small percentage of those players begin adjusting their positions at the same time, the impact doesn't stay contained. It becomes global. Now add another layer to this, the Federal Reserve. Because as yields spike, financial conditions tighten. That slows economic activity. But if the Fed steps in too aggressively to stabilize the bond market, it risks sending the wrong signal, or worse, fueling inflation again. So now the central bank is caught in a balancing act. Do nothing, and markets may spiral. Do too much, and credibility is at risk. And in moments like this, every decision matters. Meanwhile, the effects are already spreading beyond bonds. Equity markets are rotating sharply. Investors are pulling out of high-growth sectors and moving into defensive positions. Utilities, consumer staples, anything perceived as stable. Gold is rising. Volatility indices are spiking. Options markets are pricing in larger swings, and liquidity, the thing that keeps markets smooth, is starting to thin out, which means even small trades can cause big moves. And that's when things can get chaotic. Now let's bring this closer to real life, because this isn't just a Wall Street story. As yields rise, mortgage rates follow. That means buying a home becomes more expensive. Almost immediately, businesses that rely on debt financing face higher costs. Hiring slows, investment slows, and slowly, almost invisibly at first, the real economy begins to feel the pressure, all from a shift that started in the bond market. And here's what makes this moment even more significant. It's not happening in isolation. Inflation is still a concern. Global growth has been uneven. Geopolitical tensions are elevated. This isn't a stable backdrop. So when something like this hits, it doesn't just move markets, it amplifies everything else that was already fragile. Now, as the minutes turn into hours, analysts are scrambling. How much has actually been sold? Is this confirmed or just partially true? Is it ongoing or already finished? Because until those answers are clear, uncertainty dominates. And markets hate uncertainty more than anything else. At the same time, large institutional players are starting to reassess. Pension funds, insurance companies, sovereign wealth funds, these are not fast-moving traders, but when they do adjust, the impact lasts longer. If they begin rebalancing away from us, debt even slightly, it can shift demand patterns for months, not minutes. And that's where this story starts to move beyond a short-term shock, into something deeper, because now the conversation is changing. It's no longer just what is Canada doing, it's is the system as stable as we thought. For decades, US Treasuries have been considered the ultimate safe asset, risk-free, reliable, untouchable. But moments like this if temporary plant doubt. And once doubt enters the system, it doesn't disappear instantly. It lingers, it evolves, and it changes behavior. Central banks begin diversifying more seriously. Institutions rethink exposure levels. Investors start questioning long-held assumptions, not overnight, but gradually. And that's how long-term shifts begin. Quietly at first, then all at once. So here's where we are right now. A single report has triggered a global reaction. Markets are volatile, yields are rising, confidence is being tested, and the full picture is still unclear. But one thing is already certain. When a country like Canada makes a move in the Treasury market, the world doesn't wait for confirmation. It reacts fast. The next few hours will matter. If this stabilizes, markets may recover quickly. If it continues, if others follow, if confidence continues to slip, then this moment may be remembered as something much bigger than a temporary sell-off. It may be remembered as the moment the market started asking a question it hasn't seriously asked in decades. What if the safest asset in the world isn't as untouchable as we thought? And once that question is out there, there's no putting it back.